Okay, so let's start. We want to start a new topic. And the topic we want to start, just a minute, sorry.
We want to start a new topic.
Just a minute. Okay. So we want to start a new topic, and the topic we want to do is a topic called cash flow statement. Some books will call it cash flow statement. Some books will call it statement of cash flow. Now, so let me introduce the topic. This is not a new topic to you. You must have done it in financial accounting. When you began the course of accounting, in the subject called financial accounting, you did this topic called cash flow statement. So I need to remind you first, what you are doing in that topic, so that once we remind ourselves, now we can continue and do something. So let me remind you first. 1, you remember, whenever you are required to prepare a cash flow statement, you had to classify your cash flows into 3 categories. Whenever you had to prepare a cash flow statement, you had to classify your cash flows into 3 categories. Of course, I do hope you remember, the first category is what you used to call cash flows from operating activities. You had to identify all the cash flows that your company generated from all the operating activities. We shall look at them in details later, but let me assume that you have identified them. Okay? I'm assuming you have identified them. Normally, some are positive, some are negative, whatever it is. Once you get that net amount, you normally get that net and push it to the extreme, whatever it is. That net amount can sometimes be negative or it can be positive. Let me assume for now that the amount is a positive amount. If it's a positive, you used to call it net cash inflow. From operating activities. Net cash inflow from operating activities. Of course, if it was a negative, you used to call it net cash outflow. Net cash outflow from operating activities. Good. Now, before we continue, let me talk to some new students. There are some new students who are joining us today. They requested for a free class. Now, listen, for those who are new, listen. I would ask you, please subscribe to my YouTube channel. Please subscribe to my YouTube channel so that you can be notified in future whenever we post new videos into the YouTube. So please subscribe to our YouTube channel. You can click on that subscription button down there. Even as you're watching this video, you can click on that subscription button. This may not be to the new students alone, even to you as our students. If you have not subscribed to the YouTube channel, please subscribe by just clicking the subscription button below there, and also the notification bell so that you are notified whenever we post new videos. Good. So please subscribe to my YouTube channel. Just click on the subscription button down there. Of course, sawa. Of course, you may also want to know the name of the channel. The name of the channel is called CPA Joseph Njuguna. That's the name of the YouTube channel, CPA Joseph Njuguna. You may want to search it later. That is called CPA Joseph Njuguna. There we have some few videos also for the public. So let's continue now. So I am talking about the format of a cash flow statement. Let me continue. And I've said, whenever you are required to prepare a cash flow statement, you are required to classify your cash flow statements into 3 categories. One is the cash flows from operating activities. I have said we shall discuss in details what they are and how to identify them. But let me assume you can still remember that how you used to identify them. Once you have identified your cash flows from operating activities, you had to get the net of all of them and push the amount to the extreme, whatever that amount. I have said, if it was a positive amount, you used to call it net cash inflow from operating activities. If it was a negative, you used to call it net cash outflow from operating activities. Good. After you're through with the first category, you had to come to the second category of the cash flows, and that's what you used to call cash flows from investing activities. Cash flows from investing activities. Okay? Again, you had to identify all of them. We shall identify them later. Of course, some were positive, some were negative, whatever it is. You had to get the net. Let me assume now that after I get the net amount, that net overall, I want to assume it's a negative. I push it to the extreme again. This time, I'm assuming it's a negative. If it's a negative, you used to call it again net cash outflow. You used to call it net cash outflow from investing activities. You used to call it net cash outflow from investing activities. Of course, if it was a positive, you call it net cash inflow. You call it net cash inflow from investing activities. That was category number 2. The last category was, once you are through with the second category, you had to come to the last category of the cash flows, and that was cash flows from financing activities. From all your financing activities as a company, how much were the cash flows from all your financing activities? Again, you had to identify all your financing activities. Again, some would be positive, some would be negative. Let me assume for now that you got a net overall positive. Push it to the extreme. Once you get it and you push it to the extreme, if it's a positive, you used to call it net cash inflow. You used to call it net cash inflow from financing activities. Net cash inflow from financing activities. Okay, good. Now we have assumed, I am assuming that you have identified your cash flows from operating, you have identified your cash flows from investing, you have identified your cash flows from financing. Once you identified those 3 categories, listen, you had to get the totals of those 3 categories. That means from the net of the operating, net of the investing, and net of the financing, add those 3 figures, whatever they give you. That amount that they give you can either be a positive again, or it can be a negative. I do hope you remember. If it was a positive, you used to call it increase. You used to call it increase in cash and cash equivalent. If it was a positive, you used to call it increase in cash and cash equivalent. Then from there, you had to add what you call opening cash and cash equivalent. You had to add opening cash and cash equivalent, meaning from the balance sheet last year, whatever was the cash and cash equivalent last year, that automatically becomes the opening cash and cash equivalent by the beginning of this year. That's why we call it opening. Then you get the net, and that total amount down there, that's what you normally call the closing cash and cash equivalent. the closing cash and cash equivalent. That closing cash and cash equivalent, listen, should always be the same, as the amount you are given in the balance sheet by end of this year. The closing cash and cash equivalent that you determine down there should always be the same with the balances you are given in the balance sheet for the current year for the cash and cash equivalent. We shall do an example. But that is the overview now. That is the overview of how you prepared or you are preparing a cash flow statement where you determined the cash flows from operating. Once you got the cash flows from operating, you went to cash flow from investing, then you went to cash flow from financing. Good. So how are you then determining the cash flows from operating activities? That's what I want you to remember now. That's what I want you to remember. How are you determining the cash flows from operating activities? And first, what are operating activities? When we say we are looking for cash flows from operating activities, what do we mean? Now listen, operating activities are those transactions. Operating activities are those transactions and events. All those transactions and events that are used in the determination of a profit of the business, those transactions are what we classify as operating activities. All the transactions and events that are used in the determination of profit, we normally classify them as operating activities. Good. Now listen. So what is the net? That's what we are looking for. What is the net cash flow from all our operating activities? All those transactions that were used in the determination of profit during the year, how much was their cash flows? Good. Now listen. You all know how we normally prepare an income statement. Let me assume that you even prepared your profit and loss in a T format. When you prepare your P&L account in a T format, you know all expenses and expenditures are normally debited. All the revenues are normally credited. Then you normally compare the revenues with the expenses and you get what we call the net profit before tax. Whatever it is. Okay, let me assume you got a net profit before tax amounting to 200 million. Now, listen carefully. We are looking for the net cash inflow or net cash outflow from operating activities. From operating activities. I've told you, operating activities are those transactions that are used in the determination of profit. So all the transactions that were used here to get this 200 million, those transactions are what we classify as operating activities. But then, listen, it is therefore reasonable to conclude that therefore, because we have taken the inflows, which are the revenues, and you have minus the outflows, which are the expenses or expenditures, it is therefore necessary to conclude, or you could conclude, that the net cash flow from operating activities is then 200 million. Because I've said, what are operating activities? These are transactions and events that are used in the determination of profit. Good. And what are we looking for? We are looking for net cash flow from operating. Net cash flow from operating, either as an inflow or an outflow, whichever it is. I have said, in principle, therefore, this net profit before tax should be, in principle, it should be the net cash inflow from operating. Why? Because you have taken the inflows, you have minused the outflows. You have got that net of 200 million. But the question is it true that this 200 million represents the actual net cash flow from operating? The answer is no. The answer is no. Why? Because it is possible that you as a company, you could have either debited your P&L account with something here, which as a company, you never paid anything for it in cash. It's true. If everything that I credited in the P&L account was by cash, and everything that I debited in the P&L account was by cash, if everything in the P&L account was by cash, then it is reasonable to conclude that this 200 million is the net cash inflow. But is it true that it is the net cash inflow? The answer is no. Why? Because I'm saying it is obvious possible to find that as a company you could have debited P&L account with an item or with an expense which you never paid anything in cash. So we refer to it as an uncashed item. We refer to it as an uncashed item. You could have also credited your P&L account with something that never involved cash at all. And that means it is an uncashed item. So we are saying, with those few items that are in the P&L account, listen, with those few items that are in the P&L account, which did not involve any cash at all, please use them to adjust this 200 million. Use those few to adjust the 200 million so that, listen, so that you get the true profit if everything in the P&L account was by cash. So that's what we want to do. So when you are required to determine the cash flows from operating activities, you always have to start with the amount we are calling profit before tax, whatever it is that the examiner will give you in the income statement. Then, now that you used some non-cash items to get it, use those non-cash items to adjust this. If an item made the profit less than it should be, then to correct it, you add. If the item, whichever the item we shall discuss, if the item made the profit more than it should be, you deduct. So let's start. What could be some of the items that you as a company, you could have debited in the P&L account and yet no cash was involved at all? Something that you could have debited in your P&L account here, yet you never paid anything for it in cash. But listen, we are not saying you did something wrong. No, the rules of accounting could have required you debit P&L account with that item. No problem. The rules of accounting, the accounting principles. But now we are not preparing our income statement. We are preparing cash flow. We want to know the cash flows from operating activities. So there are so many things that as a company, you could have debited your P&L account with, yet no cash was involved. One of them is depreciation. When you depreciated your asset this year, whichever it is, you must have debited P&L account with that depreciation charge, which is okay, according to accounting. But from the cash point of view, that depreciation amount did not involve any cash, So we are saying, if we got a profit before tax here of 200 million, suppose that 5 million depreciation, let us assume it's 5 million. Suppose that 5 million was not in the P&L account and everything else was by cash. What would have been the true profit? If the 5 million depreciation was not in the P&L account, what would have been the true profit? Would it have been more than 200 million or would it have been less than 200 million? It is obvious, listen. By including that 5 million in the P&L account, which is okay. But from the cash point of view, listen, from the cash point of view, now we can say that your expenses are overcosted. From the cash point of view, your expenses are overcosted. By including that 5 million depreciation, your expenses are overcosted. We know when expenses are overcosted, obvious profit is undercosted. When expenses are overcosted, profit is undercosted. So to correct this 200 million we are assuming, and assuming it's the only item, then you will come back and add that depreciation charge, whatever it is. Because by you debiting it in the P&L account, it overcosted expenses. From the cash point of view, it overcosted expenses. Then I've told you, when expenses are overcosted, profit is undercosted. So to correct it, you add. Now, because it's not a new area to you, now I want you to chart and give me some other non-cash items. Give me other examples. Listen to this now. Give me other examples of items you could have either, listen, either debited P&L account with or credited P&L account with them, yet no cash was involved. Yet no cash was involved. So give me an example. Give me an example. Other examples. I have said this is not the first time you are doing the topic of cash flow. No. Give me other examples. And by the way, when I'm asking you for that, I am now not asking you from the accounting point of view, from the cash flow point of view. No. I am just asking you to think as an accountant. What is it that could have been debited, in the P&L account or credited in the P&L account, yet no cash is involved? Think of any transactions. There are too many. Something that you normally take to the P&L account, yet no cash was involved. So chart and give me what you think. Good. Bad debts. That's correct. Let me explain it. That's correct. When a debtor is declared bankrupt, you have to write him off. To write off that bad debtor, you normally credit debtors. And debit. You normally credit debtors and debit P&L account, or you normally debit bad debts and credit debtors. Once you debit bad debts, that bad debt goes to the P&L account as an expense. But did you pay for it? No. You never paid for that amount. But because it's a loss to you, you had to debit. You had to recognize that loss called bad debt. So bad debts is another example of a non-cash item. Again, you debited P&L account. From the cash point of view, it made your profit less. In other words, your expenses were overcosted. When expenses are overcosted, then automatically, then that means when expenses are overcosted, profit is undercosted. So we shall be adding. So that's the second one. Somebody's giving me again another one. Correct. Amortization. That's correct. Amortization. Listen. When you amortize your intangible assets, copyrights, trademarks, maybe softwares, you amortize. Most of the intangible assets are normally amortized. So it's the same as depreciation. When you amortize your depreciation, your assets, non-intangible assets, you must have debited P&L account. By debiting P&L account, and yet you never paid anything in terms of that amortization, that automatically, again, from the cash point of view, that makes this profit to be wrong. So we adjust it by coming again and adding that amount you're giving me as amortization. Good. Another one. Before I go to Simon, I go back to Jacob. Jacob, I want to clarify something and you get it right. Jacob, I want to clarify something for you because what you have given me, listen, Jacob, what you have given me, it's true. Jacob is saying revaluation. It's very true. Listen carefully. When you revalue an asset, maybe it's machinery, motor vehicle, furniture, building, listen, let us assume you revalued an asset called land. You must have debited land and you must have credited the account called what? Revaluation. Whenever you revalue an asset, you normally debit asset and credit revaluation. Listen, then that revaluation balance, which we call revaluation reserves, goes to the balance sheet. The revaluation reserve goes to the balance sheet among the equities, where we normally say ordinary share capital, share premium, retained profit. We put their revaluation reserve. Jacob, listen. As much as is true, revaluation is an uncashed item. Listen, as much as is true, revaluation is an uncashed item. Is it, listen, is it affecting what I'm looking for? I have said, we are trying to look for what should be the true profit if everything in the P&L account was by cash. So that revaluation, it could be a gain or loss. Did it go through P&L account? The answer is no. Whenever you revalue an asset, you debit asset, you credit revaluation. Then the revaluation reserve goes to the balance sheet as a component of equity. But it doesn't go to the P&L account. Whenever you revalue an asset, you don't debit asset, then you credit P&L account. No. It does not. Listen, it does not affect P&L account. As much as it's true, revaluation is an uncashed item. So I hope, Jacob, you have understood what we are saying. You are not the only one who have given me this before. It is true that some students tell me revaluation. As much as it's true, revaluation is an uncashed item. It does not go through P&L. It goes direct to the balance sheet. And we are trying to ask ourselves, if everything in the P&L account was by cash, what would have been the true profit? That's why we have taken that profit and adjusted it with the few things that are in the P&L account which never affected the cash. Good. So we leave revaluation. Somebody else has given us impairment. That's correct. Somebody else have given us impairment. It's true. When you impair some of your assets like goodwill, then that impairment is not something you paid, but you recognized a loss. So we can come and say again, you add any impairment loss. Any impairment loss. Good. Now, the others like income tax, somebody's giving me income tax, that's no. Remember, tax come after. Listen, somebody's giving me tax. Tax normally comes after the profit. In the income statement, we normally say profit before tax, then you minus tax. What are we adjusting? We are adjusting the profit before. Listen, you went to the P&L account, you got this profit before tax of 200. We normally deduct tax of, let's say, 10. You get profit after tax of 190. What are we adjusting? We are adjusting the profit before tax. So this tax, is it affecting what I'm adjusting? No. So tax, you don't use it among, listen, you don't use it among the non-cash item. We shall talk about it, where to use it. Good. Correct. Somebody else is also saying gain or loss on disposal. Very correct. I can see most of you can now remember. When you sell an asset, let's assume you bought a motor vehicle. No, you sold a motor vehicle at a time when the book value was 10 million. You sold a motor vehicle at a time when the book value was 10 million. You sold it for cash. You sold it for 8 million. So it is obvious when you sold it for 8 million, you sold it for less than its book value. And therefore you sold it at a loss of how much? 2 million. That loss of 2 million, you took it to the P&L account as an expense. You took it to the P&L account as an expense. Therefore, any loss on disposal, we shall also be adding loss on disposal. Correct. It was debited in the P&L account, yet we never paid anything for it. It's just a bookkeeping entry. If you sold that motor vehicle for 18 million, you had a motor vehicle which had a book value of 10, you sold it for 18 million. That means you made a profit on disposal of 8 million. You made a profit on disposal of 8 million. That profit on disposal, you credited your P&L account. You credited P&L account. In other words, you added it to the gross profit. You know that. But did we receive the 8? No. 8 was just the non-cash item that went to the P&L account. What you actually received is 18. But 18 did not go to the P&L account. What goes to the P&L account is the gain or loss. So by you recognizing a gain in the P&L account, listen, it made your profit now more than it should be. It made your profit more than it should be. Okay? So now that it made your profit more than it should be, you will come and less any gain on disposal. You will come and minus any gain on disposal. You minus good. Whatever it is. Now, listen. Listen. There is one more non-cash item. I want you to listen. There is one more non-cash item which you have not given me, but it will obviously be found in any question you have ever done or you will ever do. Yet you have not given it to me. There is one item we normally consider as an non-cash item, which you will always find in any question you ever did or you ever will do. Investment income is not an non-cash item. Caleb? No. That's who? Gits? No. Investment income is something you received. It's an cash item. But we shall talk about it. I'm looking for non-cash items. But for investment income, I'll talk about it later. Okay? I'll talk about it later. Okay. I'm still looking for, listen, I'm still looking for non-cash items. A transaction that went to the P&L account whereby no cash was involved at all. No cash was involved at all. Now listen. Thank you. Thank you. I was almost assuming that nobody can remember it. I was almost, because I was waiting to get it from you, but nobody gave me. But at least this is who says has given us. Thank you. And let me talk about it first. Thank you, Mwendwa. Now you are giving me when I'm insisting. Okay, Sawa. You should have given me earlier. Now, let me explain now. Let me explain it. Very correct. And the amount is what we call finance cost. Now, let me explain it by using an illustration. How finance cost is another non-cash item. Now listen. When you did published accounts or company accounts, doesn't matter, let's assume it's company accounts, you used to be given a trial balance in this nature. In that trial balance, you will be given a 10% debenture, which amounts maybe to 500,000. Okay? In that same trial balance, you could be given interest on debentures, 40,000. Now, in your topic of company accounts or in your topic of published accounts, it is also tested. If the examiner gave you a trial balance of this nature, then he tells you to prepare an income statement or what we can call profit and loss. What you can call profit and loss. How much, the question is this now, how much will you charge in the profit and loss account as the amount of the interest? How much will you charge in the P&L account as the amount of the interest? Somebody quote for me. Somebody quote for me. You must have done it in published accounts. You must have done it in financial accounting and company accounts. When you are given a trial balance of this nature and you are required to prepare the income statement of the company, how much will you charge in the income statement for this company concerning interest? I'm waiting. How much would you charge as interest for this company? You have done company accounts. In your financial accounting, you have done published accounts. It's the same. I'm waiting. When you are given a trial balance this way and you are told to prepare an income statement, how much will you charge as interest in the income statement for this company? Yes. How much? 50. Good. Thank you. Thank you. Correct. Now listen. Listen. When you are preparing an income statement, we normally follow the concept called accrual concept. Accrual concept. That says you recognize cost when it is incurred, but not when money is paid. You recognize cost when it is incurred, but not when money is paid. So when you are preparing the income statement for this company, you realized every year our company is supposed to pay their debenture holders an interest at what percentage? 10%. 10% of 500, that comes to be 50,000. So whether you have paid it or not, listen, whether you have paid it or not, it is not the concern of the income statement, no. Because the income statement says recognize cost when it is incurred, but not when money is paid. So this year, you must have charged the P&L account by how much? 50. When you are doing the balance sheet for this company, listen, that's the time you became concerned and asked yourself as a company, do I owe my debenture holders anything concerning interest? That's the time you went now to the trial balance and asked yourself, have we paid them anything? Then you realize, oh yes, we have paid them how much? 40. Oh, I was supposed to pay them how much? 50. How much have I paid? 40. So what have I not paid? 10. So it is the balance of 10 that you had to take to the balance sheet among your current liabilities. Debenture interest owing of how much? 10. That's how you used to treat this. But listen, what you took to the P&L account as 50 is not what you actually paid. No. You just took 10% of 500 to be the charge for the year. Whether the company had paid it or not, your income statement doesn't bother. What bothers is the balance sheet. But whether you have paid the 50 or you have not paid the 50, you still have to recognize it. So that 50 is obviously another non-cash item. It's obvious, another non-cash item. Why? Because to get it, we just took 10% of 500 and we got the charge of 50. Okay? That 50 is another non-cash item. Listen, even when you used to be given a trial balance this way, in that trial balance, you're just given 10% debenture, 500. And in the same trial balance, there is nothing like interest. There is nothing like interest. Why are you still charging interest in the income statement? The answer is yes, whether you have paid it or not. So like in this scenario now, you would say, every year I'm supposed to pay my debenture holders at 10%. 10% of 500 is 50. Whether I've paid it or not, I have to recognize it as an expense. That's what you did here. Okay? Then, when you'll be preparing your balance sheet, that's when you'll ask yourself again, have we paid our debenture holders their interest from this trial balance? No. So, it means the whole amount of 50 became the charge for the year, and the whole amount will become the liability by the end of the year. But my point is, what you took to the P&L account is not what you paid. It is the charge for the year, which is 10% of the 500. Are you there? Good. Now, listen. So listen carefully. Whenever you are doing a question on cash flow, two non-cash items will never miss. Will never miss. One, depreciation charge for the year. Two is what we are calling finance cost. Those two will never miss. The others, bad debts, impairment, amortization, loss on disposal, gain on disposal, and others. You have even not told me provision for bad debts, but it could also be there. Let me add it. Provision for bad debts. When you anticipate that some debtors are likely not to pay you, you normally make a provision for bad debts, whatever it is, and many more. But what I'm trying to say is, whenever we shall be doing a question on cash flow, we shall be asking ourselves two obvious non-cash items: depreciation, finance cost. Those two, don't forget it. Why should you lose marks for those two? Yet you know they will be there. Even marks for picking the profit before tax, why should you lose it? The mark for picking the profit before tax, why should you lose it? Then you also need to know there will be depreciation charge. There will be finance cost. Okay? To get the finance cost, listen, to get the finance cost, just go to the income statement that the examiner has given you. You all know, you have done cash flows before. Every time the examiner is testing you on the question on cash flow, whenever the examiner is testing you on this topic of cash flow, he will always give you the income statement for that particular year in two balance sheets, one for last year and one for this year. So from the income statement, you can clearly see that this company charged 50 as interest. So you pick it. That is not something to calculate. No. Now, the rest, I have said, of the non-cash items, those ones you find some in the question, some other questions don't have them, and so on. Not all questions will have the rest. Listen to this now. So for purpose of illustration, let me assume that I have identified the non-cash items. Once I have done that, I get the total. That total is what you used to call, that total is what you used to call cash flows before working capital changes. Cash flow before working capital changes. Good. Then you had to incorporate now, you had to incorporate the working capital changes themselves now. You had to incorporate now the working capital changes. So let's incorporate them now. So you had to go to the balance sheet last year and this year and look for those working capital. Working capital items are items of current assets and current liabilities. For example, in the balance sheet, you could realize there was increase in stocks. Maybe stocks last year was 5 million, stocks this year are 8 million. It's obvious for stocks to have gone up, you as a company must have done what? You must have purchased. That's an outflow. For stocks to go up, you must have bought. That's an outflow. Good. Then you go to the balance sheet again. Among the current assets, you realize there's debtors. Last year debtors were 5 million. This year debtors are 4 million. So if there could be maybe a decrease in debtors, what does it mean? For debtors to go down, they must have paid us. They must have paid us, meaning we must have received. That is obviously an inflow. Good. Now listen. Among the non-working capital items, I've said there are current assets and current liabilities. Among the current assets, there is always stocks, debtors, then there is always cash or bank. Listen, for cash or bank, you don't use them here. For cash or bank, you don't use them here. Why? Because I told you at the end down there, I've rubbed, I don't know how I've rubbed, but you remember, down there I told you, once you get the totals of the three categories, you get the total, we call it increase in cash and cash equivalent, then we normally add opening cash and cash equivalent. So though cash is a working capital item in the balance sheet, but we don't use it among the working capital changes. No, it has its own specific place in the cash flow, which is where we have said it will be among the opening cash and cash equivalent, or it will be among the closing cash and cash equivalent down there when you are preparing your cash flows. Good. So let me assume for the current assets I'm through, I go to current liabilities. Among the current liabilities, let me assume there was creditors. And maybe creditors last year were 5 million. This year creditors are 4 million. What could have happened? For there to be something like a decrease in creditors. What happened? For creditors to go down, you must have paid. You must have paid. That's an outflow. Good. So let me assume those are the only working capital items. Get the net. Once you get the net, now you come and deduct. I hope you still remember. Now you deduct what you used to call tax paid. Find out if they have not given you. It is something you have to calculate. How much tax did we pay this year? How much tax did we pay this year? Listen. So this figure I'm getting here, it is like the profit before tax if everything was by cash in the P&L account. Then you come and minus the tax now. Once you minus the tax paid, now whatever you get, you push it to the extreme. I am assuming it's a positive. You call it net cash inflow. You call it net cash inflow from operating activities. Net cash inflow from operating activities. Good. So we are through with the first category of the cash flows. We are through with the first categories of the cash flows. Now we go to the second categories of the cash flow. And when I was introducing, I told you the second category is what we call cash flows from investing activities. Cash flows from investing activities. First, we need to remind ourselves, what are investing activities? We are looking for the cash flows from investing activities. Now listen, investing activities are those, listen carefully, investing activities are those transactions and events, that affect any fixed asset. A transaction that affects a fixed asset or fixed assets, that kind of a transaction is classified as an investing activity. Any transaction affecting fixed assets is classified as an investing activity. Good. So it's obvious, as a company, you could have bought motor vehicles this year. So if there was a purchase of fixed assets, either motor vehicle, machinery, whatever, it is obvious that's investing, and that was an outflow. It could be during the year you sold your motor vehicle, sale of fixed asset, whether motor vehicle, land, building you sold, that must have affected a fixed asset. That's an inflow. Good. Now listen, among your fixed assets in the balance sheet, you as a company, you could have an investment. You know, long-term investments are normally classified. Listen, you know, long-term investments are normally classified in the balance sheet as a fixed asset. So if your investments last year were 5, and this year the investments are 6 million, what could have happened? It could be you bought some more investments. So even purchase of investments is also another example of an investing activity. You bought some investments. Okay, good. Now listen. These investments gave you an investment income. Maybe you bought shares from Safaricom, and the Safaricom is giving you dividends from your investment. Listen, any income that you are receiving from an investment, that income should be classified as an investing activity. Any investment income should be classified as an investing activity. You received from your investments. Your investments are fixed assets. So when you receive income from them, then that is an investing activity. When I was asking for the non-cash item, I saw somebody giving me investment income. Listen, somebody gave me investment income. And I was telling him that investment income is not an non-cash item. It is something you received. So, and you received it from your investments. So that is considered as an investing activity. Now, listen. What I want to think that person meant is this. And I want you to watch. Because when we are doing a cash flow question, you have to be a bit careful for that investment income. Listen carefully now. You are given this as the income statement of your company, gross profit, whatever it was. Then the question gave you admin expenses, distribution expenses. They got what we normally call profit from operations. I hope you are following. Then we normally get what we call finance cost. Whatever it is, you minus. Then we said you normally bring in your investment income. Whatever it is, you normally add. Then you normally get this figure we are calling profit before tax. Which for my case now, I'm assuming it's how much? 200 million. Now watch. This is what I am hoping the student was thinking. when you took this 200 million and you brought it here in your cash flow statement here, then you asked yourself, are there non-cash items? Yes. That was used to determine that 200 million. Yes. Finance cost, depreciation, amortization, impairment, loss on disposal, gain on disposal, provision for bad debts, and so on. Listen. Now, to get the same 200 million, they added that investment income. Let us assume it is 10 million. In the income statement, the treatment is right. But now we have concluded, listen, we have concluded investment income should not be an operating activity. Investment income should not be an operating activity. Instead, it should be a financing activity. It should be a financing activity. No, investment income should be an investing activity. Now, listen carefully. So, in case your question will have this kind of a P&L account, that 10 million, listen, that 10 million investment income, you will have to, listen carefully, you will now have to come here. Don't forget, you are looking for cash flows from operating activities. Is the 10 million an operating activity? No. The 10 million was an investing activity. But what am I looking in the first section of my cash flow? I'm looking for cash flows from operating activity. And to get this 200 million, the company added 10 million. So that 10 million investment income, we shall be deducting it here. Listen carefully. We shall be deducting it here, not because it is a non-cash item. No. We shall be removing it from the 200 million and taking it to where it belongs. Where does it belong? It belongs to the investing, that 10 million. So when somebody said deduct investment income, I am hoping he did not mean we are deducting because it's a non-cash item. No, it is a cash item. It is a cash item. It's only that it is part of the 200. But it is not an operating item. It is an investing item. So when you deduct it from there, you are only realigning it. Listen, you are only realigning it to where it belongs. Realigning it so that you take it where it belongs. It does not belong to the operating, it belongs to investing. So when I was asking the non-cash items, at that point, I did not expect to be given investment income. Why? Because I'm saying true investment income is a cash item. You received it. But other non-cash items, depreciation, loss on disposal, gain on disposal, impairment, amortization, all those are non-cash items. But within those items, I'm also going to be adjusting. that investment income, if it's part of the question. Reason being, it was used to determine the 200, but it is not a cash item. Sorry, it is not an operating item. And what am I looking for in the first part of the cash flow? I'm looking for the cash flows from operating activity. So that 10 million, we shall only be realigning it to where it belongs. So I don't know who gave us. I hope he has understood now. You can say yes. You told me to deduct investment income, and I told you no. Because that time, I was only looking for non-cash item. But now, I have explained to you that investment income is part of investing activity. But because it was used in the determination of the 200 million profit, and it's not part of the operating, it's part of investing, so we had to remove it from operating and take it. We had to remove it from operating and take it to where it belongs, that is investing. Okay? So I am hoping the person who gave us that has now understood why we normally don't use it as an uncash, but we still use it in that list because we have to realign it to where it belongs. I hope you have understood. If you have understood the person who said it, you can say yes. Now we can continue. Now, for now, listen. For now, let me assume that I'm now through also with the investing activities. Normally, there are not many in a question. So let me now assume that I'm through with the investing activities. We get the nets. Some are positive, some are negative. Get the net, push it to the extreme. For purpose of illustration, I want to assume again the amount is a negative. If it's a negative, I said you call it net cash outflow from investing activities. Net cash outflow from investing activities. Good. Now you come to the third category. Now you come to the third categories of the cash flows, and that is what we called cash flows from where? From financing. You come and say a cash flow from financing activities. Cash flow from financing activities. What are financing activities? These are transactions that affect, any transactions that affect finances. That's what we call financing activity. Could be you issued some shares during the year. Shares are part of financing, and the money came in from the issue of shares. Good. Another source which can be classified as financing could be issue of debentures. As your company, debentures last year were 10 million. Debentures this year are at 15 million. For debentures to go up, you must have issued some more debentures. Good. Money came in. Could be you repaid your loan. So maybe there is a loan repayment. Last year, the loan was 10 million. This year, the loan is 6 million. For the loan to go down, you must have repaid. That's an outflow. Good. Once you do that, listen, let me again assume that you have identified the major financing items, the major issue of shares, issue of debentures, loan repayments, or maybe debenture repayment, and so on. Listen, once you identify the major sources, listen to this now, you have to come and pay these financiers. You have to pay them their return. For example, to the shareholders, we normally pay them dividend as their return. So we normally say any dividends paid to the shareholders, any dividends paid, it's considered as part of financing. Dividends paid are classified as financing activities. To the loan providers, to the debenture holders, we normally give them their own return in terms of interest. So any interest paid is also considered as part of financing, whatever it is. Again, let me assume that I'm through with the major financing items now. Let me assume I'm through with the financing items. Okay. Sorry. Once you're through with the financing items, get the net, push it to the extreme. Let me assume it's a positive. I call it net cash inflow. We call it net cash inflow from financing activities. Net cash inflow from financing activities. Then I told you, get the net of all of them. Now you have the operating figure, you have the investing figure, now you have the financing, now get the net. I told you that net, if it's a positive, we shall be calling it increase in cash and cash equivalent. Then we shall be adding what we call opening cash and cash equivalent. Whatever it is, then you get the net down there, that down amount, we call it closing cash and cash equivalent. We call it closing cash and cash equivalent. Now you know the general format of a cash flow statement. Now you know how to prepare a cash flow statement. Good. So before we look at the minor details, because there are small details which you still need to know, maybe for now, let's put down the format, the general format now. So the topic is cash flow statement or statement of cash flow. Put down the topic, statement of cash flow. Statement of cash flow. Statement of cash flow. Then you say this below there. The following is the format. The following is the format of a cash flow statement. Following is the format of a cash flow statement. So let's put down neatly now. So we come and say your cash flows. Cash flow from operating activities. Cash flows from operating activities. Cash flows from operating activities. I told you start with the net profit before tax. Whatever is net profit before tax, you pick it. I've told you adjust it with all non-cash items. Two of them I told you are obvious. One of them is the depreciation charge. Whatever is the depreciation charge. The other one I've told you, which is a must find, is what we have called finance what? Finance cost. Whatever it is. Then I told you the rest will now depend with the question. Like what? Like amortization. Like what? Like impairment loss. Like what? Bad debts. Like what? Like provision for bad debts. Provision for bad debts. Like what? Like loss on disposal. Okay. Like what? Less gain on disposal. Let's now put in that student's amount. Less investment income. Let's just put it there to remind you that it is not an operating item. I have not said it's not a cash item. It's a cash item, but it's not an operating item. I'm only taking it to where it belongs. Good. Then you get the net. That net is what we called what? Cash flow. before working capital changes. Cash flow before working capital changes. Good. After that, we now bring in the working capital items. I gave you an example. Increase in stocks. That is obviously an outflow. For stocks to go up, you must have paid to buy some more. Good. Then I came and said, dear, decrease in debtors. If debtors go down, you must have received from your debtors. Good. After that, we come to decrease in creditors. That's an outflow. Next, let us assume that's all. Get the net. And from there, I told you, come and you see your tax paid. Whatever we paid this year for taxes, you minus. Then I told you, whatever you get now, push it to the extreme. I want to assume it's a positive amount. We said if it's a positive amount, you call it net cash inflow from operating activities. Net cash inflow from operating activities. Good. After you are through with the operating, we have just concluded, go to the second category, and that is what is called, if you are through, cash flows from investing activities. Cash flows from investing activities. Okay. We give an example. We said examples could be purchase of fixed assets. That's an outflow. Could be sale of fixed assets. That's an inflow. And I told you, purchase of investments. That's an investing activity. That's an outflow. And I told you, investment income. That's an inflow and it's coming in. And I assumed, suppose those are the only ones. From your investing, get the net, push it to the extreme. I want to assume that the net is a negative now. If it's a negative, we have said call it net cash outflow. Net cash outflow from investing activities. Net cash outflow from investing activities. Good. Then you go to the last category. That is the cash flow from financing activities now. Come and see your cash flow from financing activities. Cash flows from financing activities. Okay. And from financing, we have said issue of shares. Whatever it is. Issue of debentures. That's an inflow. Loan repayment. Loan repaid. That's an outflow. And I told you, those are the major finances. Pay the returns to the financiers. One of them is dividends. The shareholders are financiers. Pay them their dividends. Dividends paid. whatever it is. There is another group of financiers called debenture holders or loan providers. They are normally paid what? Interest. Whatever it is. Get the net. Push it to the extreme. Let me assume again it's a positive. That is what I called net cash inflow from financing activities. Net cash inflow from financing activities. Good. Once you have the three categories now, what did I say? Get the totals of the three. I am assuming you have a positive amount. I called it increase in cash and cash equivalent. Increase in cash and cash equivalent. And I told you, add opening cash and cash equivalent. Whatever it is, and get what we called closing cash and cash equivalent. Good. So that is the format of the cash flow that we shall be adopting anytime we shall be preparing a cash flow question. Okay. I'll finish copying now. Okay. For now, we have no time to start and do any example or to develop the other points I mentioned. I'll develop them later. But that is the general concept of a cash flow. Otherwise, there are some other details we shall be talking about in our next class. Maybe for now, we can stop there. We pick it up from there next time, where now we shall continue from there. I told you there are some new students in the group. So let me talk to them now. There are some new students in the group. Now listen. For you students who want to continue with us, some of you are new today, because today was a free class. Now listen. If you want to continue with us for FR, then our classes are always every Tuesday and Friday from 8 p.m. to 10 p.m. Our system is such a way that in case you miss a class, assuming on a Friday you are working, does it mean you are going to miss that class? The answer is no. You can still go back to the group where the link was posted and you'll be able to watch your video at your own free time. That's the good thing about our system, that you, even if you miss a class, you don't have to panic. You can still watch your video at your own free time. Okay? If you join now, you will still get the videos of all the previous classes. You will get all the videos of the previous classes that you have so far missed, so that you create time to listen to them. Okay? Good. If you are interested in continuing with us, then you can call me on this number 0722 65 8875. Good. Some of you could be here and you are doing advanced financial reporting because it's a common topic. If you are doing advanced financial reporting, you could be here because today it was a free class and cash flow is for everyone. because it's involved also in the advanced. It's only that they develop it further. For advanced financial reporting, those who are here, we normally have early morning classes and we normally have evening classes. Our early morning classes normally starts from 5:30 in the morning to 7 a.m. in the morning. Every Monday, Wednesday, and Friday. Okay? That is the timing for early morning. Evening normally again starts from 8 p.m. to 10 p.m. every Monday, Wednesday, and Saturday. Again, listen, the system is such a way that in case you miss a class, just like I've said for a financial reporting, the same applies for advanced financial reporting. That in case you miss a class, don't panic. Just go back to the group where the link was posted. You can be able to watch your video at your own free time. I've said again, if you join now, you still get the videos of your previous classes or the videos of your previous classes that you have missed so far. Good. Again, if you are interested, if you are here and doing advanced, their number is 0722-658875. Currently, for both FR and advanced FR, we are having an offer. And we are charging 3,000 shillings for any new students joining right now. Before it was 4,000. Now we have an offer of 3,000 shillings. Good. For some of you, you have friends who are doing financial accounting of the foundation level. Tell them also we are teaching financial accounting. Some of you have students who are doing financial accounting of ATD1 and ATD2. There is also financial accounting there. We are still teaching it. Okay? Good. Listen, whether you are doing advanced or you are doing financial reporting, listen, if you may not be available during these class times, you can also buy what we call pre-recorded videos. You can buy what we call pre-recorded videos so that you listen to them at your own free time, at your own pace. I give you all the videos for the whole syllabus, all of them at once, so that you listen to them at your own free time, at your own pace. Good. So I think I've explained everything. Over and above that, I've told everybody now listening to me, that please subscribe to my YouTube channel. Please subscribe to the YouTube channel as you are even watching now if you have not subscribed, so that you can be notified in the future whenever we post videos, free videos to the YouTube. So please subscribe to my YouTube channel. I told you the channel is called CPA Joseph what? CPA Joseph Njuguna. That's what I told you the name of the channel is. May you want to listen to some more videos, you can go to CPA Joseph Njuguna channel, YouTube, and there you'll get. I think I've explained everything. So maybe for now we can stop there. So please, if you're here and you're a new student and you want to continue with us, either for FR, intermediate, or advanced financial reporting, advanced level, we are available. I've given you the timings. I've given you my contact. You can call me even after this. Good. Otherwise, good night, everyone. Good night, everyone. See you next time. Otherwise, see you next time. Bye for now. Let me close the meeting. Let me close the meeting for now. Bye for now. So for my normal students and any other person interested, let's meet next time where I'll develop the topic. Then we do a few questions now. Bye for now. Good night. Good night.